Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to Qingyi. Good evening. Today is Thursday, December 11th. I'm analyst Zhang Jin, bringing you my 3 notes. Please like, subscribe, and share for us. If you have any investment questions, feel free to leave me a comment. If I don't get to answer your question today, I'll make sure to address it in tomorrow's class. Now today we've just gone through the most important and final interest rate decision of the year. So after that's been settled, next week it won't be my turn to do the live stream. So I'll finally get to take a little vacation and enjoy the last bit of my December break. No matter how your trading went over the past year, whether it was good or bad, I hope you'll continue to support us at Kuan Yu Investment Advisory as we head into the new year and look forward to 2026. As for our investment content, whether it's the Good Morning Show, the Morning Call, or our entertainment programs, we'll keep providing even better and more relevant information, covering everything from international markets to Taiwan stocks and US stocks. We hope that in 2026, everyone's investment journey will become more stable and that you'll all make big profits. Alright, first, let's take a look at today's investment highlights. Good evening, everyone. Good evening, Hui Juan, and hello to Mei Dai Z, Brother Yulin, and Flying Fish. Also hello to Shishi, CC, Cash Call, Golden Bull Classmate, Alice Fu, Keikoko Lee, Javelin, and OM Bird. Good evening to you all. Alright, let's go ahead and note down today's key news. First, how should we interpret the Fed's interest rate decision? At 3 a.m. today, the much-anticipated Fed rate announcement was finally released. In Powell's related remarks, was the tone more hawkish, neutral, or dovish? What are the implications for monetary policy in 2026 and the outlook for the stock market? I'll be sharing a lot with everyone today. There were many important points mentioned in this statement, and what are these key points? The outlook for the market remains relatively bullish, and with the US midterm elections coming up next year, when you put these 2 factors together, everyone can try to approach their strategies and positions from a more bullish perspective. So why is that? What are the bullish highlights? Today, I'll make it clear for everyone. On the other hand, when it comes to individual stocks in different industries, it's a different story. Maybe the index has a chance to hit new highs and keep climbing, but honestly, the way individual stocks move can be very different. For example, just at the beginning of the show, one of our viewers asked, today, when we talk about the stock market, why did the US market open high and then fall yesterday? Does this kind of open high then fall pattern mean that all the good news has already been priced in? I'll add some thoughts on that in a bit. As for the index, to put it simply, in the short term, it might encounter a dovish stance from the interest rate decision, leading to a surge followed by some pressure and pullback after a strong rally. But it's not enough to turn into a bear market yet, so there's no need to switch to a bearish outlook. So everyone doesn't need to worry too much, but this kind of short-term volatility will intensify. Also, after a big rally, a corrective pullback is something everyone should pay special attention to right now. After all, the whole market is already focused on the confirmed news that the Fed will cut rates this December. Looking ahead, the focus will be on next year. How many times will rates be cut? Once or twice? That will further affect everyone's strategies and positioning for 2026. As for the industry side, let me add a bit more, especially since yesterday, after the US market closed, there was some important news about AI. The key company here is Oracle. Oracle plays a very important role in AI infrastructure and related areas, both in terms of performance and its overall role. Whether we're talking about its involvement in Trump's so-called Stargate project or its collaborations with OpenAI and SoftBank, Oracle is right in the mix. Or with NVIDIA, OpenAI, and so on. This is what we call the interconnectedness of the so-called AI perpetual motion machine. So what kind of information did Oracle's latest financial report reveal? How did its revenue and profits perform? And especially, what about the cash flow that the market is paying close attention to? Specifically, the free cash flow. What issues have arisen in terms of capital expenditures? And why did this cause Oracle stock to plunge 11% in pre-market trading today? I'll explain all this in a moment. The other company is Intel. As for Intel, it's currently facing the so-called EU antitrust laws. Although they lost the lawsuit, they even received what? They received complaints from Ukrainian citizens. What kind of impact will this have on their revenue and stock price? In addition to sharing this with everyone, there's another piece of news about Intel. But when we talk about Intel, we have to mention the more important big brother in the semiconductor industry, which is The guardian of our nation, TSMC. TSMC's revenue for November has also been announced, and the results are quite impressive. Foreign investors have even raised their target price. Yesterday, TSMC's ADR hit a record high. In fact, it reached a new intraday high. After setting this new record, combined with the November revenue, the results once again met expectations. So what's next for TSMC? What about Intel? Of course, TSMC is the most important. I'll explain everything clearly for everyone. Good evening, everyone. Let's take a look. Good evening, Louis Yang, and also Caesar, and Mr. Who is that? Is this a new student? Hello, Mr. Lewis. As for Wang Baba, today he's restocking at a night market in Taiwan. When you say Wang Baba, do you mean Jensen Huang? Or who are you referring to? Let's take a look. First, let's check today's data. Later at 9:30, there's a pretty important economic indicator coming out. The US weekly jobless claims and travel demand numbers. We'll check on that later. And if the data is released, I'll update everyone. For now, let's preview it a bit. For travel numbers, last week it was 191,000. The forecast is 220,000. As for continuing claims, the previous value was 1,939,000, and the forecast is 1,947,000. Overall, for initial claims, the number should stay between 200,000 and 230,000. This range hasn't changed for now. Alright, so for now, nothing has changed. There is no change in that issue. As long as the number of people filing for unemployment benefits doesn't spike significantly, there's no need to worry too much about the job market collapsing, or even the US economy heading toward a hard landing or recession. Right now, the current job market is at most just cooling off, slowing down and getting a bit weaker, but it hasn't reached the point of collapse yet. So everyone can see signs of weakness in the job market, and later on we can tie this back to the latest Fed meeting, including what Powell had to say. Welcome everyone! The Fed has repeatedly mentioned the job market. Right now, the job market has become their biggest concern, second only to inflation. So what's going to happen with this data release at 9:30? Also, at 11 o'clock p.m., there's the US wholesale sales monthly rate for September. The previous value was 0.1, and the forecast is 0.4. This data is relatively neutral, so if it's released at 11 p.m., its impact on the US stock market should be pretty minimal. In fact, the initial jobless claims and continuing claims are actually more important. Some people say, by the way, that Jensen Huang is the king. Okay, good evening everyone, and good night to those in Asia. For these two data points, just keep an eye on them tonight. That's enough. What's more important is, what exactly was said in the interest rate decision at 3 a.m. today? You've probably seen a lot of coverage this morning, whether it's from financial media or various news programs. After watching all that, I'm not sure what everyone thinks. But anyway, before the US stock market opens tonight, I want to give everyone a final summary. No matter if the news you heard today was more bullish, bearish, or neutral, we're going to do a full summary tonight. After that, I'll also talk with everyone about the investment directions and strategic focuses for next year in 2026. Based on the interest rate decision, which direction is better to take? Let's take a look first. As for all the interest rate decisions, just as the market expected, they cut rates by 0.25%, bringing it down to 3.5 to 3.75%. This is actually the third rate cut this year. In this interest rate decision, among the voting committee members, there are supposed to be 12 members. Out of the 12 votes, the result was about 9 to 3. 9 supported the rate cut, while 3 opposed it, 3 votes against. You might ask, does having 3 dissenting votes mean there's a huge difference in the overall monetary policy, and that's why they analyzed it? Oh, not necessarily, not necessarily. These 3 votes against just mean they oppose this particular quarter-point rate cut. In fact, if we break down these 3 dissenting votes, it's actually 1 hawk and 2 doves, 1 hawkish member and 2 dovish members. Who is the hawk? Not that kind of big brother. Not the first or second brother, okay? The hawkish member here refers to the new Fed governor, Miss Milan. She actually supported and hoped for a half-point rate cut this time. As for the other 2, who are more dovish, or rather more on the dovish side, they supported keeping rates unchanged. For example, Schmidt or Goolsbee. They believe that inflation is still relatively high. So in this interest rate decision, the 3 dissenting votes were 1 supporting a bigger rate cut and the other 2 wanting to keep rates unchanged. What does that mean? It means there were no votes for a rate hike, not a single one. Request. Do you understand what that means? At most, it's just a difference between keeping rates unchanged or cutting them further. No one is saying they want to raise rates. No one is saying inflation is high, so I'm reconsidering and want to hike rates. Not at all. So remember that. At most, they're neutral, otherwise they're dovish. Neutral at best, otherwise dovish. That's an important point. Second, regarding the rate cut of 0.1%, they're planning to start buying $40 billion in treasury bills starting December 12th. This is also a move toward a more accommodative monetary policy. Right. People are saying that the outlook for the US is highly uncertain, or that inflation remains elevated. These arguments, talking about economic uncertainty and inflation staying high, are actually the same as what was said in September and October. Nothing has changed. Then finally, he mentioned the interest rate level for the year after next. It's expected to be cut by one more notch, meaning in 2026. And then another cut is expected next year. In 2027, there might be another cut as well. This is their current assessment as of December. Now, will this change next year? Yes, it could change next year. Next year, the Fed will adjust according to employment market data, inflation data, and pressure from Trump. International news, changes in the trade war, fluctuations in the US economy due to the election, all of these will affect the highs and lows of interest rate decisions. So this is a floating value. Based on December's outlook, he was just telling everyone that there might be one rate cut next year, and then another one the year after next. But will this data change? It definitely will. If everyone has a general idea, that's good enough, because there are still many variables next year. Chairman Powell said that consumer spending remains solid, and businesses are investing and expanding. Of course, he mentioned the labor market. The labor market is a point that many committee members are currently quite concerned about. The worry is that because the trade war has been so confusing and uncertain this year, it might affect companies' layoffs and hiring, so the job market is relatively weak. In fact, all 12 Federal Reserve districts have mentioned related issues, that is, the continued weakness in the labor market. Powell highlighted an important point. He said that it's now estimated that employment could decrease by 20,000 jobs each month, so 20,000 jobs lost per month. In other words, if we see poor performance in the upcoming non-farm payroll numbers, it could mean that the number might drop to 30,000, or even that only 30 or 50,000 new jobs are added. If it turns out like the ADP private payrolls, and we actually see a decrease of 30,000 jobs, there's no need to be overly worried. Powell has already told everyone that in the coming months, employment could decrease by 20,000 jobs each month. So it's pretty clear that the employment numbers aren't going to look very good. In addition, there's an important anchor number to pay attention to. He mentioned that the unemployment rate at most will only increase by 0.1 to 0.2 percentage points. Based on the most recent non-farm payroll unemployment rate, the latest US unemployment rate is around 4.3% to 4.4%. So if you think about it, even if it goes up by another 0.1 to 0.2 percentage points, that means the US unemployment rate would top out at around 4.5%, or 4.6% at most, which is still within the Federal Reserve's controllable range. So what does that mean? It means that as long as it's within 4.4, 4.5, or 4.6%, it doesn't count as an economic recession. If you interpret it simply like that, you'll get it. Wow, so why is this kind of anchoring so important? For example, back in September this year, around September, there was also an interest rate decision. And at that time, Powell also told everyone this. Based on the current level of PCE, according to this PCE, or core PCE level, at most, if the trade war continues, if the trade war goes on, this year's PCE will only increase by another 0.2% to 0.3% at most. Alright, so the past average was about 2.8 to 2.9. So if you add 0.2% to 0.3%, it's roughly within 3.1%. That's still within the range where the Federal Reserve believes inflation is not out of control. Oh, so even 3.1 or 3.2 are still within a controllable range. That's why every time he speaks, the specific numbers he mentions are really important. So now everyone knows that as long as inflation stays within 3.1 or 3.2, the Federal Reserve doesn't think inflation is getting out of hand. If the unemployment rate stays below 4.5 or 4.6, that means that most of the market is just cooling off, but it's not heading toward a crash. So when everyone looks at the Federal Reserve's interest rate decisions or statements, don't just focus on what they say about rate cuts, whether it's once or twice, or their GDP or PCE forecasts. That's not all there is to it. After the official statement, there are a lot of subtle nuances, especially in what the Federal Reserve Chair says. You need to break down and analyze his words. Once you do that, you'll understand their stance on employment and inflation for the coming months, or the next quarter. And knowing their stance tells you whether, over the next 2 to 3 months, their monetary policy is likely to lean more dovish and accommodative, or more hawkish and tight. So you have to be able to read between the lines. There's always more to what he says and meets the eye. Because the Fed chair can't just come out and tell you directly, I'm going to cut rates by a quarter point next month, or we're going to ease policy and buy $40 billion or $50 billion in treasuries. He can't tell you that in advance, because that's how monetary policy works, and that includes fiscal policy too. If monetary policy or fiscal policy decisions are revealed to the market before they're finalized, or if the market gets wind of them too early, then that policy often becomes ineffective, and its impact is usually reduced, sometimes significantly. That's why Powell talked about this. If the unemployment rate increases by 0.1 to 0. This is something to take note of. In other words, right now, around 4.5 to 4.6 is still within a controllable range. Another important highlight, which is related to tariffs and inflation, is that he said if right now, in December and starting from January, if Trump doesn't introduce any new tariff policies, let's think a bit more long-term here. Let's talk about next year. If Trump doesn't stir up trouble and doesn't start any new tariff wars, then based on the current tariff rates, if we evaluate things as they are now. Even Powell said that at most inflation will peak in Q1 of next year. What does it mean for inflation to peak in Q1 next year? Right now, if we're talking about core PCE, it's around 2.8% or 2.9%. So next year, it will hit its highest point for the first time. All right, so at most, let's just say it's 3%, okay? Let's assume that in the first quarter of next year, inflation really does spike to 3%. He said that after the first quarter, it will peak, and then starting in the second half of next year, it will begin to fall, and fall. So it might reach as high as 3%, and then gradually drop from 3% to 2.8%, 2.9%, 2.5%, 2.4%, 2.4%, slowly coming down. Of course, this would be favorable for the Fed to take action in the second half of the year. The timing of rate cuts, okay? So you need to remember these key time points. He said that in the first quarter of next year, we might see the peak will be reached, and once we hit the peak, it will start to go down. The second anchor data point is the unemployment rate, which is around 4.5 to 4.6. Just remember that. That's enough. As for what he said about the future, the difference will be whether the Fed keeps rates unchanged or starts cutting them. It's the same. If not unchanged, then it's this type. There's no option for raising rates, no option for rate hikes. And finally, he didn't disclose whether he would stay on after his term ends. The committee didn't say anything, didn't mention it, so we don't know either. In the end, whether he'll continue to stay on the board after May next year is still unknown. Will he continue to influence monetary policy, or will he just step down? Nobody knows. Anyway, that's something to talk about in May next year, so we'll just have to wait and see. That's why the key points in this December rate decision and the statement are extremely important, because it's the last one of the year. It also sets the stage for monetary policy all the way through 2026, and what kind of stance the Federal Reserve will take. In fact, they shared a lot of highlights, data, and material to help everyone interpret whether the Fed will lean dovish or hawkish next year. Overall, I think their interpretation this time is relatively dovish, and they've basically already told everyone what to expect for next year. Next year, it's either going to be a rate cut or rates will stay the same, okay? And the unemployment rate will probably fall within a certain range, and inflation will likely peak out most in the first quarter of next year. That's about it. So overall, I think there's a good chance that after the first or second quarter of next year, they'll start implementing rate cuts again. So it's still something we can look forward to. As for the details from the Bureau of Labor, they include things like GDP, unemployment rate, PCE, and so on. So I'll definitely provide all of that for everyone. For GDP, their baseline estimate is 1.7%, rising to 2.3% next year, and then reaching 2% in 2027. Looking at the next 4 years as a whole, the GDP is being revised upward each time, which means the economy is not in recession. Yeah, the economy is not in recession. As for the unemployment rate, it stays the same for this year and next, at 4.4 to 4.5%, but by 2027, it drops to 4.2%. As for the fourth item, core PCE, it drops from 3.1 this year to 3%, and next year it goes down to 2.5%. So overall, it looks like inflation is cooling off, and the unemployment rate is gradually stabilizing. And what about the economic data? It's showing growth, so that's pretty good. This situation is actually kind of similar to the so-called Goldilocks economy concept. As for the interest rate level, this year it's projected at 3.6. Well, this year is almost over, and the current interest rate range is 3.5% to 3.75%. Next year, there's a possibility of a rate cut, bringing the average down to about 3.4%. Then in 2027, the median is expected to be around 3.1%. So gradually, there's likely room for a quarter-point cut next year and another quarter-point cut the year after that. This is the key information from the important interest rate decision and statement released early this morning, for your reference. As we look ahead to 2026, at the very least, you should have a sense of direction and know that the current monetary policy, at the very least, it's generally favorable for the stock market and economy. It leans positive. All right, Melissa and Bubble Water, good evening. Jeff asks if this is good news already priced in, and if there's a short-term effect of good news being digested. Yes, that applies to both Taiwan and US stock markets. As we said yesterday before the interest rate decision was announced, no matter what happens, if the market surges, just sell once. So yesterday, it was around 2 or 3 o'clock. We were having a meeting, and as the meeting was going on, after Powell started speaking, the market just kept surging upward, almost closing at the highest point on the index. The US stock market, like the Dow Jones, all closed at their highest points. Speaking of the highest point, today, I just checked the futures market. Today, it went up quite a bit again, but then pulled back and dropped about 0.5% to 0.8%. So it's just fluctuating. Whenever there's a surge and you don't sell, someone else will, especially now that the rate cut news has already been announced. Good evening to everyone who's working late. And also, Hakuna Hakuna, good evening to you right away. That's a really unique name. Good evening, good night. So moving on, of course, Powell cut rates by a quarter point, but Trump still isn't happy. Trump keeps criticizing Powell. By Powell, I mean Jerome Powell. He thinks that, as for the rate cut, he thinks it could be doubled, and ideally, it should be lowered to the lowest in the world. Of course, that's what he hopes for. Why does he want that? Some people might be concerned, wondering why does Trump keep insisting on rate cuts, wanting rates to go down, ideally to zero? Is it possible to cut rates to zero? Not really. It's unlikely to reach zero in the short term. Why does he want the current interest rate, which is at 3.5%, 3.6%, 3.8%, or just over 3%, to keep dropping, ideally to zero or even to 1? Why? First of all, cutting rates is inherently a huge positive for the stock market. Lowering rates is the biggest boost for both the economy and the stock market. It's like we always say, cutting interest rates is a cure-all. When you cut rates, basically the economy gets a fresh flow of capital. That money comes in and it either goes into buying stocks, companies making investments, or people spending more. Okay, just think about it. If right now, take Taiwan's fixed deposits, for example. What's the current interest rate on fixed deposits in Taiwan? If, say, it was 10%. Yeah, if it was 10%, everyone would want to put their money in the bank, right? Because a 10% interest rate at the bank is much less risky than stocks, since it's a risk-free return. If it drops from 10% to 0%, then what? Would you still want to put your money in the bank? Of course not, because you might even have to pay management fees to keep it there. So at that point, what would you do? You take it out to spend, to invest, or to do all sorts of other things. Sometimes even some pretty odd things. So both businesses and regular people would take their money out to invest. That's why lowering interest rates actually has power, because it gets money moving in the market. It brings out liquidity. That's the reason. So cutting rates is like a cure-all. It's generally good for the economy. On the other hand, of course we hope for lower rates, for US interest rates to be a bit lower. Why? Because right now, the total US national debt has reached $38 trillion. Not new Taiwan dollars, but US dollars. It's as high as 38 trillion US dollars, and with the current interest rate at only 4%, if you buy these government bonds, the 10, 5, or 30-year bonds, the interest rate can be 4% to 4.5%. With interest rates this high, if today the rate could drop from 4% to only 1%, it would be great. Right? That would mean paying 3% less in interest. So just do the math. With $38 trillion, if you pay 3% less in interest, you can imagine how much that is. It's several trillion dollars. So it's really, really scary. That's why Trump definitely wants interest rates to go down. On one hand, it would help the economy and the stock market, and on the other, the interest payments on US debt would decrease, which would reduce the burden. It's all connected. Now, the yield on US Treasury bonds is at 4.14% because, well, things have settled down and the market expects there will probably be one rate cut next year. So what does this mean for rate cuts? Right now, it looks like there will only be one rate cut. That's why the yield on US Treasury bonds has risen to 4.14%. Of course, there are some other reasons as well, and the market is also looking forward to something special from the Bank of Japan next week. The Bank of Japan is different from other countries. It's actually moving towards raising rates. Unlike other countries like Europe, the UK, the US, Canada, or Mexico, many are moving toward rate cuts. But Japan is different. Their interest rates have always been extremely low. They even had negative interest rates. Now, after several increases from negative rates, it's only at 0.5%, which is still very little. So the Bank of Japan might act next week. It's quite possible that they might raise interest rates, so this rate hike could have some impact on the yields in Europe and the US as well, at least to some extent in the short term, I think. So take a look at the current government bond yield, which is now at 4.14, and the interest rate remains at 3.65. As for the number of rate cuts, let it be for now. Next, let's look at next year, then we'll look closer. In 2026, we'll see the direction of rate cuts. The US dollar index, as Trump actively pushes for rate cuts. As for the Federal Reserve, this time they cut rates by 12 basis points. What about next year? Judging from their relatively dovish stance, we can see that the US dollar index still dropped by 0.15% today. In the short term, it's still hovering below both the 50-day and 200-day moving averages, showing a relatively weak trend and a period of weak choppy consolidation. Now, looking at New York crude oil prices are even weaker at this stage. The bearish trend in oil prices continues and hasn't changed for now. There weren't too many geopolitical risks today, so I don't have much to add on that front. As for oil prices specifically, they fell by 1.27%. Overall, I just quickly skimmed through. And right now, whether it's the IEA, EIA, or OPEC monthly reports and so on, the content of these reports, at most, the original demand growth rate compared to the previous period hasn't changed much. There's not much difference. It hasn't really increased or decreased. It's basically stayed flat. But regarding the issue of supply exceeding demand in the market, all three major reports have more or less pointed out this problem. That is, the current market demand for crude oil has already. It's clear that demand is less than the market supply. Of course, this is relatively unfavorable for crude oil prices. That's the situation with crude oil. As for the data, at 9:30, we'll take a look at the changes in employment and wholesale sales monthly rates. Especially, the initial jobless claims will be announced around 7:30 p.m. There aren't many economic data releases tomorrow, but there is a committee member named Paulson who will be speaking. Including Shen, if I remember correctly. I think his term is until 2026. Of course, when next year comes, we'll come up with a new, easy-to-remember mnemonic for everyone, so you can keep track of which board members and voting members there will be next year, and who might be rotating in. For example, last year, well, actually this year, 2025 isn't over yet, so in 2025 we'll tell everyone about it. In the Federal Reserve districts, the rotating members are just like that. The so-called rotating members are 4 committee members. So who will it be next year? It might be Paulson, or maybe, what was it, Hallmark or something? I forgot. Anyway, we'll follow up with everyone when the time comes. There will be another 4 next year. They won't be joining us, but there will be a lot of changes next year. As for Lee C's position, it's uncertain whether Cookeries will be replaced, which is something everyone is paying attention to right now. Then there's Powell. Next year, Chairman Powell might also be replaced, and if he is, who will take his place? It could possibly be Hassett. Anyway, it's just a big game of musical chairs, with lots of changes coming. As for the earnings reports, I'll talk about Oracle with everyone in a bit. I just mentioned something about Oracle. Okay, who was it? Frank Lee, right? Let me answer your question. If Japan cuts interest rates next week, well, it's actually very unlikely that Japan will cut rates next week. Basically, it's 200% certain they won't cut rates. Is it possible that not cutting rates, or even some capital outflows, will affect the US stock market? At the moment, it doesn't look like there will be much impact. At most, what might happen is that Japan will move toward raising interest rates next week. A rate hike is almost a sure thing, so a rate cut next week is impossible, because right now, the Bank of Japan is shifting toward raising rates, not cutting them. If they do raise rates, of course, in the short term, it will put pressure on the Japanese stock market, because as we've said, rate cuts are good for the stock market. So raising rates, what will the capital do? Pull back, which is favorable for rate cuts. For the stock market, raising rates is relatively unfavorable. So if the Bank of Japan does raise rates, it will put pressure on Japanese stocks. If Japanese stocks drop, will that put pressure on US stocks and drag them down? I think the chances are slim. Not much, but if you're talking about Asian countries like China or Hong Kong stocks, there might be some impact just because they're geographically closer, all Asian countries. But as for whether a drop in Japanese stocks would cause a drop in US stocks, I think the correlation is pretty low. On the contrary, the rise in the US stock market might actually pull up the Japanese stock market and other countries' markets. So the US stock market is still the one to watch, the most important market. Yes, the most important one. Okay, who's this? Edison May. Good evening. Let me take a look. I'd like to ask, when you're analyzing individual stocks, besides looking at the price and the interaction with moving averages, for example like Granville's rules, can you also combine it with volume and chip analysis? For example, you can definitely do that. It's just that, for example, when it comes to US stocks, we often don't specifically look at volume, chip analysis, or institutional buying and selling. Usually, when we analyze Taiwan stocks, we tend to use these volume and price indicators more. Especially in Taiwan, institutional buying and selling, margin trading, and short selling are very transparent pieces of information. So when we look at this, whether US or Taiwan stocks, besides the fundamentals you mentioned, like individual stock direction or moving averages and other technical indicators, we also combine and match all these elements. Usually for Taiwan stocks, I also look at trading volume, chip distribution, institutional investor activity, margin trading, and short selling. I pay attention to major player inventory flow. I observe all of these. Regarding Taiwan stocks, a brief discussion. As for Taiwan stocks, how do I usually approach them? This is how I typically do it. Every week when I'm on duty for the evening show, Good Night, we usually talk about macroeconomics and US stocks, basically international financial topics, with a particular focus on US stocks. But when I'm not on duty for the Good Night live stream, during the daytime, I usually focus on the Taiwan stock market, or I might be giving talks at branch offices, which are mostly about Taiwan stocks. Occasionally, I'll talk a bit about US stocks through sub-brokerage, and if I have the chance to speak at a live event, I might mention things like volume and price, or even the 3 major institutional investors, or other related topics. As for the open interest of foreign institutional investors in futures, I'll usually touch on that during my talks. Also, now, if time permits, every Friday at 3:30 in the afternoon, our group has added a little segment, a short program that lasts about 3 to 5 minutes. We'll talk about some of the key things to pay attention to for the coming week. The content of those 3 to 5 minutes will probably focus more on the Taiwan stock market. We might highlight some important points about Taiwan stocks, what to watch out for in the coming week, and so on. So every Friday at 3:30 in the afternoon, there will be this short regular segment. I'll share more details with everyone when the time comes. As for the US stock market, we'll still be using price moving averages, along with industry news and fundamentals to help explain and provide some guidance for everyone. Alright, so besides Oracle, this week we also have companies like Costco, Broadcom, Avago, and who else? Lululemon, which has already taken a beating, just dropping and dropping. It's fallen so much that I don't even want to look at where it's gone anymore. Ugh. But Broadcom is still considered an AI stock, and it's one of the key leaders in ASIC chips. In the ASIC chip space, there are two main leaders. One is Marvell, and the other is Broadcom. Broadcom is especially important because it collaborates with Google. Oh, Broadcom works with Google. And as for Google's TPU chips in areas like Gemini 3 and so on, they perform extremely well. And today, I've also heard that Meta wants to use Google's TPU chips. So who designs and manufactures these chips? It's Broadcom. So Google is doing well in this area. Broadcom is rising with the tide, benefiting across the board. That's why when you compare Broadcom's recent performance to Marvell's, they're completely different stories. Marvell has been trending downward, but Broadcom, on the other hand, has been going up. If there are any issues, of course, when they release their earnings tomorrow, we'll follow up with everyone about Costco and Broadcom. Costco's performance probably won't be too bad. Consumer spending still looks pretty good at the moment, especially after Thanksgiving, when a lot of earnings reports have been quite strong. This time, the US Thanksgiving retail sales monthly rate and even Cyber Monday after Thanksgiving have both been solid. Next up, we're heading into the Christmas holiday season, which is the peak period for sales. Right now, retail sales are looking pretty good, with a year-over-year growth rate of 4% in the US and about 6% globally. So overall, the performance has been quite strong. It seems like the monthly retail sales numbers are doing well, and Walmart's earnings report should be pretty decent too. Alright, next, let's take a look at the earnings report. But before we get into the earnings, it's almost 9:30. So let's first check out the latest initial jobless claims numbers, and then we'll talk about Oracle and negative interest rates. Negative interest rates mean that when you put your money in the bank, you might actually have to pay the bank a management or service fee. For example, the Bank of Japan did this before. They implemented negative interest rates. I remember several years ago, they went to negative interest rates, like negative 0.1 or something like that. That's what's called negative interest rates. Alright, Lululemon's stock price dropped, but their yoga clothes are still super expensive. Yeah, they're still really expensive. Speaking of those yoga clothes, they're crazy expensive. My dad wants us to exercise. Around me, I have some friends who like to work out. Some of them do, what is it called? I think it's called tiramisu? Oh wait, tiramisu is a dessert. What was it? Pilates, right? Haha, I can't remember the name. Pilates is kind of like stretching your body, but it's not quite the same as yoga. Yoga is probably more like, I think yoga came from India, right? Yoga was brought over from India. The poses in yoga and the stretches and pulls in Pilates are a bit different, just a little, but overall, they're pretty similar in form. So some people do Pilates. Pilates is basically stretching your muscles, stretching things out, and some people even use external equipment or devices to help with these stretching movements. Because nowadays, we spend too much time sitting in offices. Like me, when I have to host this group live stream, I usually get to the office around noon, like 12 o'clock. As soon as I get to the office at noon, I just sit down and start looking up information, reading through materials, typing, and then working on presentations and all that. Basically, except for bathroom breaks, I keep at it until about 6 in the evening. I don't go eat dinner until 6, and after I come back from dinner, I rest a bit, then tidy things up, and by around 7 or 8, I start getting ready for the live stream. So nowadays, most of us are just staring at screens for work, or we're scrolling on our phones. So sometimes in your spare time, you really do need to. Doing some exercise, yoga, or even Pilates is actually really helpful for stretching your body. It makes you feel better, more energetic, and healthier overall. But I remember those classes aren't cheap, not cheap at all. Back then, I heard a friend say that they were taking yoga or Pilates classes like that. For those classes, I'm not sure if each session is 1 hour or 2, but a single class costs almost $1,000. It's really not cheap at all. Anyway, just to clarify, I'm not talking about tiramisu, not the dessert, and not sparkling water either. I mean Pilates, not tiramisu to eat. There are a lot of Black Friday discounts. Yeah, right now for Black Friday, there are tons of deals on all kinds of things. Someone said, Amy, you just finished working out, right? That's great. Working out and swinging your arms, really good. So now it's 8:30. Let's take a look at the economic data. The latest economic numbers have just been released, including the attendance figures. Just now, processed people reached 236,000, higher than expected and previous value. Continuing claims are now at 1.838 million. Why so much lower? Why the sudden drop? 1.838 million. What data is that? More or less? Or unclear? Anyway, continuing claims are 1.838 million. It's a significant drop compared to expectations, and lower than the previous value. There must be data adjustments, otherwise how could it suddenly drop from 1.94 million last week to 1.83 million? Where did those 100,000 people go? Did 100,000 people just stop claiming unemployment benefits? Are they ignoring it? If they ignore it, they're still unemployed, but can't keep collecting benefits, so they're not included in this data anymore. Maybe that's the case, I don't know. But for now, when it comes to people showing up for work, it's 236,000, which is higher than expected, higher by 1,000. That means overall unemployment. In the short term, the number of people filing for unemployment benefits this week seems to be just a little bit higher, just a bit higher. But is it totally out of control? Not really, not at all. So does this mean the job market is a bit weaker? Of course. That would actually support the case for more rate cuts next year. As for that 1.838 million, as for this unemployment benefits number, I think we can just take a quick look at it. Use it as a reference. As for the reason why it dropped from 1.94 million to 1.83 million, maybe if there's time, I can give everyone a bit more explanation about that tomorrow. So this is just some initial information to share with everyone. This is the very latest update from 8:30. Pilates, Pilates, Pilates. That's just an English word transliterated into Chinese. The whole market is talking about Oracle. That's right. Okay, let's take a look at Oracle. Oracle. This Larry Ellison. Weren't we just talking about Oracle a couple of days ago? What were we discussing about Oracle? It wasn't about Oracle's earnings report. Yesterday, we did talk about Oracle's earnings report, about what the EPS and revenue actually were. The day before yesterday, we were talking about Oracle. His son is the one from Skydance, the company that's in a joint venture with Paramount, right? He doesn't know, and with Warner Bros. Too. We mentioned that there are some political maneuverings involved. So in fact, Oracle is connected to Warner Bros., Skydance, and Paramount. There are a lot of entanglements, and it's also related to Trump. All right, let's take a look at Oracle's earnings report. As for the earnings report, someone mentioned yoga. Yoga is pretty good. Then there's benign paroxysmal positional vertigo, the issue with dislodged ear crystals. Everyone seems to have studied this. Impressive. Speaking of dislodged ear crystals, this might be getting off topic. I once saw a video where someone was teaching how if your ear crystals get dislodged or out of place, you can get them back to the right position. Otherwise, you'll feel dizzy. I'll talk more about this with everyone another time. It just so happens that a classmate in the chat just brought up the issue of dislodged ear crystals. I just remembered seeing that video a few days ago. Let's look at Oracle's earnings report. Why the focus on Oracle's earnings? Because the market is concerned about AI development. There's worry about increased AI capital expenditure, increased AI debt spending, and whether AI-related revenue, profits, and cash flow might face major problems. Especially for major CSP providers or AI development companies, they're investing an enormous amount of capital. With such high capital expenditures and costs being poured in, the question is whether they can actually generate positive cash flow. This will directly impact their future profitability, revenue, and ability to maintain liquidity. That's why, with this Oracle earnings report, the market is watching them so closely, because Oracle, from earlier this year up until the end of August, has been under the spotlight. Looking at their financial report, there's something in there called free cash flow, or FCF. As of the end of August, their FCF was negative $6 billion. Negative $6 billion. In other words, they're basically spending more than they're bringing in. Cash flow looks bad. What about Alibaba? Their Q3 report announced $16.1 billion in revenue, a 14% year-over-year increase, but still below market expectations. Yesterday, we expected 16.4 or 16.7 billion, so it's lower than anticipated. Their cloud business, it's nearly $8 billion. And yes, there is growth, an annual increase of 34%, which is pretty good. So the company is still growing, not declining. However, the growth still fell short of market expectations. This is the logic the market is following right now. With AI companies being valued so highly, you absolutely have to report revenue and profits that exceed expectations. If you fall short, the market will just beat you down because they think your valuation is too high and your cash flow isn't healthy. So right now, for these AI companies, especially in the third quarter, their financial reports really have to beat market expectations because only then will the stock price go up. If they fall short, the stock price usually drops immediately, sometimes even falling below the 200-day moving average. As for EPS, it's $2.26. That's not bad, better than expected. Yesterday, we mentioned that the expected EPS was $1.64, so this time they outperformed expectations. All right, and then they also mentioned that their remaining performance obligations are still at $523 billion, which is a 400-fold year-over-year increase. A 400-fold increase! That's a year-over-year growth of 438%, which is better than expected. What does that mean? It means they still have over $500 billion worth of orders that they need to fulfill, to process, to deliver. This is another positive signal. It shows that their future revenue growth potential is still very strong, but the main concern in the market isn't whether your revenue is good or not. We talked about this yesterday. Whether your revenue is good or not, that's just the baseline. That's your basic score. Meeting expectations, that's just the basic score. At most, if you meet expectations, it means you get a passing grade of 60 points. But if you don't meet expectations, you'll be written off right away. So this time with Oracle, their revenue missed expectations, but their EPS beat expectations. So it's just a mix of good and bad, nothing outstanding. Another concern at home, let me tell you about the cash flow part. In this earnings report, they said that for the quarter ending in November, the FCF, free cash flow, was actually negative $10 billion. Yesterday, didn't we say that by the end of August, it was negative $6 billion? Now it's even more, negative $10 billion. So not only did it not narrow, it actually got worse. Fourth quarter EPS estimate is between $1.70 and $1.74, in line with expectations. Annual revenue growth, 19 to 21%, also met expectations. Cloud revenue grew 40% year over year, still pretty good. Estimated total annual revenue for fiscal year 2026 is $67 billion. This is just in line with expectations, not exceeding them, just meeting expectations, so it's viewed neutrally. Then there's another thing that everyone is worried about. Besides, your free cash flow actually went from negative $6.1 billion to negative $10 billion, $6 billion. Everyone is getting really anxious about that. Now you've gone from 6 billion to 10 billion. So what are people doing? Everyone's thinking, wow, what's going on with you? Why has your cash flow turned into 10 billion US dollars? Almost 330 billion new Taiwan dollars. That's a huge amount. People are going to worry. And then last quarter's capital expenditure, 12 billion, which is higher than the market's expectations. In addition, they said that next year's total capital expenditure will reach as high as 50 billion. Compared to their original forecast, the forecast from September, it's an increase of 15 billion US dollars. Now, you might say, teacher, doesn't that mean Oracle is doing really well? Their capital expenditure has increased so much, which should mean they have a lot of orders, and that's why they're spending so much. Normally, if you look at this with Microsoft, Google, or some other companies, when their capital expenditure goes up, you can clearly tell it's probably because they have a lot of orders, so they need to spend more. But when it comes to Oracle, people see it differently. Why? Because the most important thing is, first, it's revenue and profit. Neither of them exceeded expectations. Second, for both the full year and the fourth quarter, at best, they just met expectations. Your capital expenditure increased so much, from $35 billion to $50 billion. Such a huge jump, and yet your revenue only barely met expectations. Next, your FCF, free cash flow, actually went from a negative 60 billion to a negative 100 billion. This means the market is going to worry about something. They're worried that your capital expenditure is so high and still increasing, but your revenue is only growing modestly. Also, your cash flow is actually this negative. Your capital expenditure is this high, and your negative cash flow is still so low. Wouldn't people be worried? Of course they would. What are they worried about? They're worried that you keep pouring money in, investing and investing, but the money just isn't coming back. It's not coming back, not coming back. So if one day, if 111 doesn't manage its cash well and can't turn things around, wouldn't it just collapse? That's why in today's financial report, the market interpreted it negatively before trading even started, causing the stock to plunge 11%. It's exactly because of what I just explained to you all. Capital expenditures are surging, but revenue is flat, and cash flow is dropping sharply. This is the seesaw effect. What should be improving isn't, and what should be tightening up isn't tightening up either. That's why there's so much doubt about this financial report. It's exactly this kind of situation. All right, Melissa, you're welcome. You're welcome. Yeah, exactly. For Peter, when it comes to Oracle, if the financial report and stock price aren't good, it's a weak stock. Right now, it's still weak. In fact, its stock price has been on a downward trend since September this year. As for Broadcom, of course, their financial report performed well, especially with their chips, so they're doing well. Broadcom's financial report should perform well. It's hitting a new high. But with Oracle, be more cautious. After negative news today, it's unlikely to hold the 200-day moving average. So once it breaks through, you need to pay attention to when it can really stabilize and get back above the 200-day moving average. Just wait and watch for that, and that's good enough. What I find especially concerning is what I just mentioned. Capital expenditures are going up, revenue is staying flat, and cash flow is actually declining. That's the issue here. You know, for a typical company, this kind of situation would really make investors feel a bit uneasy. But if you take a step back, I mean, Oracle was such a huge company. Will this kind of seesaw situation I just described really cause the company to run into liquidity problems or even go bankrupt? Well, it's not that bad. It's not that tragic. It's just that in the short term, the way they use their funds or leverage might make the market feel a bit uneasy. That's basically how I see it. So in terms of stock price performance, there's relatively more pressure. All right, now let's talk about TSMC. Looking at TSMC, our national treasure is really performing well. Yesterday, its ADR in the US stock market started climbing even before the September interest rate announcement was released. After the announcement, which turned out to be a dovish rate decision, TSMC hit a new all-time high. I remember it surged past $313 during trading. Really, really impressive. And in November, their revenue was 343.6 billion Taiwan dollars. That's a 6% decrease month over month, but a 25% increase year over year, setting the third highest record in history. For the first 11 months, their total revenue was 3.5 trillion in new Taiwan dollars, and the year over year growth is also over 30%. So overall, I think if their December revenue can stay above 300 billion new Taiwan dollars, then their fourth quarter performance target for this year should be achievable without any major issues. So TSMC saw that they might get AI GPU orders, and the target price was set at 1688. The Morgan Stanley analyst who set the target at 1688 is likely Chinese, because foreign investors likely don't understand 1688 or ilu fa fa. So this is probably for next year. So Morgan Stanley is looking at TSMC and setting the target at 1688. Everyone can just take that as a reference. Of course, if we really look at it from a fundamentals perspective, according to Bloomberg or our market estimates, TSMC's EPS for this year. For this year's EPS, I remember it's already around 70 something, maybe 67 or 77. This year, it's probably about 70 or 70 something. For next year, some people are already projecting 77 to 80, already seeing 77 to 80. So since this year is almost over. So to put it simply, just do a quick calculation. In 2026, if TSMC's EPS reaches nearly $80, just as an assumption, assuming that with the booming growth of AI, if it hits $80, then you take that $80 and multiply it by a price to earnings ratio of 20. Or multiply it by a PE ratio of 25, and you can roughly figure out the range where foreign institutional investors might set TSMC's target price for next year. Then, based on TSMC's target price range, you can work backwards to estimate the general trend of Taiwan's stock market. Assuming TSMC reaches that range, meaning a PE ratio of 20 or 25, then you can estimate what level the Taiwan stock index might hit. Simply using TSMC to forecast the Taiwan stock index is the easiest method, because TSMC currently accounts for as much as 43% of the index's weight, which is extremely high. So when TSMC moves, it affects the whole market. Even a small rise in TSMC can move everything. That means every point represents 8 points. $1 means 8 points. So if it goes up $10, roughly 80 points. That's why major international companies rely on TSMC's chips. So TSMC did well yesterday, up 2.22% to a new all-time high, and staying above both the 20 and 50-day moving averages. The current bullish structure hasn't changed at all. As long as the quarterly moving average keeps trending upward this month, and the moving averages don't fall below previous levels, plus its fundamentals and revenue continue to perform well, I think TSMC's stock price still has room to keep climbing. And finally, just a quick mention about the Intel situation. Let's just keep an eye on it for now. What's this about? Intel, AMD, and Texas Instruments are being accused by dozens of Ukrainian civilians. Accused of what? Accused of not properly controlling their chips, so that these semiconductors ended up being exported to Russia and used for things like missiles or drones, which have caused civilian casualties. So they filed a lawsuit in a Texas court, accusing them, saying they didn't do a good job of controlling and managing their products. I think this accusation should be invalid because Intel and AMD, for example, can say, I sold my products to a certain company, but who that company resells to is out of our control. We don't know either. As for what those other companies use the products for, nobody knows, and there's no way to track it. So I think this accusation will probably end up going nowhere. As for Intel, sometimes, well, the EU has an antitrust fine. Originally, it was 376 million euros, and then, as the story goes, The EU's second highest court said, I rule that you still have to pay this antitrust fine, but they reduced it from 376 million euros to 237 million euros, which is about a one-third reduction. As for what happens next, Intel might appeal again. Maybe they'll keep appealing. Maybe after another round, it could get cut by another third. And in the end, the fine could even drop to 200 million, or even 150 million euros. It's all possible that it could keep going down. So overall, whether it's the Ukraine situation or this EU fine, I think in the short term, it won't have a huge impact on Intel's stock price, revenue, or profits. Just treat it as news, because after all, right now, Intel is still mainly affected by other factors. SoftBank has invested in them, right? I think SoftBank Japan invested about $2 billion, and Nvidia invested about $5 billion, taking a 5% stake. And what about the US government? They invested nearly $9 billion, getting almost a 9.9% stake. So SoftBank holds 2%, Nvidia holds 5%, and the government holds 10%. Altogether, that's about 17 or 18%, all held by these major external shareholders and big players. So when you talk about Intel, no matter how badly it drops, it won't be terrible. In the short term, all these positive factors are gradually reflecting. Everyone should pay attention. The 20 and 50-day moving averages are sticking together, and the price for the year is exactly the same, unchanged. So this price absolutely cannot be broken. The 20 and 50-day moving averages are currently sticking right at this price level. So don't let it fall below that level. If it does, in the short term, it's likely to trigger a correction after a big rally. Even though there are so many big investors and major backers supporting it, you still need to be cautious at this point. After all, the positive news for the stock price has already been gradually priced in. As for the negative factors we just mentioned, their impact isn't significant. Things like antitrust issues or the situation in Ukraine, just take note of them, but that's about it. As for the US and European stock markets, companies are rising in pre-market trading. Netflix is also up in pre-market trading, rising by 1.33%. Visa is up by 1.1% as well. Additionally, companies like Merck, Southern Company, and Albemarle are all up about 0.5% in pre-market trading. Actually, there aren't any really major heavyweight tech stocks making big moves, so the only thing is that today's tech stocks probably won't perform like the Philadelphia Semiconductor Index, NASDAQ, or S&P 500. There's quite a bit of pressure, mainly due to Oracle. Oracle dropped nearly 12% in pre-market trading because its earnings report fell short of expectations. American International Group is down 3.42% in pre-market. As for GE Vernova, it surged yesterday, up about 15 or 16%. But today it's pulling back after that big gain, down about 1.8%. AMD, Nvidia, and Intel are down between 1.7 and 1.8% in pre-market trading. Even Broadcom is down by about 1.6%. Overall, I think the market is leaning a bit bearish. After the index hit a new high, everyone knows that the Fed has already confirmed a rate cut. With the rate cut confirmed, it is inevitable that we will see some short-term pullbacks after such a big run-up. This is a correction after the rally, so all good news is priced in. As the old saying goes, take profits when the market is high. If there's a pullback to a good moving average, buying point, or company, we can slowly accumulate at lower levels. Looking ahead to 2026, I still see plenty of opportunities. The Dow Jones Index rose 1.05% yesterday. Today, just watch if the 20-day and 50-day moving averages hold during a pullback. The Philadelphia Semiconductor Index rose by 1.3% yesterday, hitting another all-time high. If there's a pullback as before, watch the 20-day and 50-day moving averages. Keep it above the circled area. If it holds, no major issues. But in the short term, watch out for profit-taking and selling pressure. As for the tarot part, it's the same as with other stocks. Just watch the 20-day and 50-day moving averages. As long as those levels hold, looking ahead to 2026, it will also be a very important confidence indicator. All right, that's all for the group-related content. This is the latest update from Big S Stagger before the US stock market opens. When class is over, remember to like, subscribe, and share for us. Lastly, I wish everyone smooth trading, and we'll see you tomorrow.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.